Called up the homeowner. I said, do you want to move out? Do you want to give me a deed in lieu? Do you want to stay in your home? And he goes, wait a minute, what? I said, well, would you like to stay in your home? He goes, nobody's asked me that before. And this guy was almost in tears on the other end of the phone.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
Hello and welcome to the RPOA Note Buying Expert Panel. We've got a great group of experts up here today who will help us understand what notes are, the investment opportunity that they provide, the pros and cons of investing in notes, and how our guests have been successful in this area. If you're interested in investing in notes, then you definitely will get a lot of great information from our expert panel today. So I'm going to give you a brief introduction to all three experts on our panel, starting with Sue Nelson, who many of you already know. Sue is a trainer and coach who has done almost every type of creative real estate deal. We've all had the pleasure of hearing her speak yesterday and today. She'll be speaking again this morning after the panel, or actually at around 10 o'clock, 10:30, somewhere in between there. She has done all kinds of deals in commercial, multifamily, REOs, and notes. And I actually joined her commercial note program back in 2012. So I've been through Sue's training. And I'm thrilled to have her on the panel. So anyway, Sue was recently a guest on the podcast, episode number 162, which came out just this past Monday. Gene Chandler has also been on the podcast. Gene is a real estate investor with 45 years of experience investing, and he's also the asset manager for Chandler & Chandler Financial, which specializes in buying one-off and small pools of distressed assets directly from banks, hedge funds, and private equity groups. Gene was a guest on episode number 80, and I was so impressed by the conversation that Gene and I had that I ended up investing with him. And Gene is now one of my strategic partners, and we have purchased 12 notes together. And maybe we'll talk a little bit about that today. Kyle Zimpleman is also an investor, and he invests in single-family performing and non-performing notes. He's also on a mission of helping distressed homeowners stay in their home, and we're going to be talking about that because buying notes is not just about foreclosing on people. It's also about helping homeowners who are in distress actually keep their homes. All right, Kyle is also the president and CEO of Expand Capital Group, and he's purchased distressed mortgages throughout the United States. He's also started a fund to help passive investors invest in this space. And Kyle was also a guest on the podcast, episode 151. Feel free, if you have questions along the way, come on up to the microphone and you'll get a chance to ask your question. Sue, we're going to start with you.
Oh, all right. Hello.
You did a great job yesterday of just kind of breaking down what a note is and what the opportunity is when it comes to investing in notes. For our podcast listeners who weren't here yesterday, and for people who also didn't hear you speak yesterday, can you start us off with the basics, the 101, what is a note, why is it a good investment?
Well, so I do more commercial notes and large multifamily notes. And REOs. I'm really interested in actually taking possession of the property or doing a workout with the owner and keeping him in the property. So the really buying notes is an excellent opportunity for you to sort of have another tool in your arsenal. I believe that if you can kind of become a problem solver for your sellers, you're in a really good position. I think that all deal making should be a process of sort of creating, for lack of a better cliche, a win-win situation where the owner of the note or the REO or the property itself walks away and they're happy and you're happy. So Buying notes is just another opportunity to buy an investment. However, when you're buying a note, you're actually buying a piece of paper. It's either a mortgage, a promissory note, a note. It has with it terms. What is the term of the note? What's the interest rate of the note? And how long that note goes for. See, what happens is I think a lot of people get very nervous about the note being, 5,000 pages long. You're not reading those 5,000 pages, okay? So you let someone else do that part. Get title insurance. Do that, but have a lawyer do it. But you're not going to be doing that. All you need to know is what is the terms of the notes and how can you work out that note, how can you work out that investment with the owner? If you're buying single family notes, I believe the best process for a private investor like us, we have a great position where we can work out an agreement with the owner who's in that property and keep them in the property because we're buying the notes at a discount if they're non-performing notes, and you can work that out. So basically, on basic terms, note is the piece of paper. Typically in real estate, it's a collateral. The collateral is the real estate, but you're not buying the real estate, you're buying the note. The note allows you to then work your position out with the owner. You can buy two types of notes. You can buy performing or non-performing notes. There are only two types of notes when it comes to that category. I particularly like, and I think a lot of us like to purchase non-performing notes because there's a lot more opportunity there for equity and to buy a deal. Performing notes are going to be typically at almost par, which means you're really not necessarily gaining some of that big discount.
Yeah, you don't quite have the spread in there.
However, there are a lot of great people who do that and make out like bandits. It's something else that other people need to talk about because it's not my expertise. Is that the kind of thing that you're looking for?
Yeah, that's a great basic understanding of notes. Does everyone understand that when you buy a note, you're not actually buying the property, you're buying the mortgage on that property. Sometimes you'll end up with the property, whether it be through a foreclosure process or cash for keys or some other scenario, but you're buying the note and someone is paying you on that note. Just like if you have a mortgage on your house, that is the note that someone might be buying. Gene, I want to go to you next and just talk about the opportunities that are in notes. I mean, why would banks want to sell notes, whether they're performing or non-performing?
It ties up a lot of their money, so they've got these loans out, and the Fed wants them to secure a lot of assets behind that if it goes bad. If it's good, then they can loan more money out on a deposit. If it's bad, they have to have more deposits to back up that loan that goes bad. Now,
and Gene, when you say if it's bad, it's non-performing because...
When it goes non-performing, yeah.
Yeah, and it's non-performing because the person is not paying on the note, or they're not paying their taxes or insurance, or keeping current with it.
And most of the time, it's 3 months behind. A lot of them really start putting a lot of pressure on people now at 2, but 3 months behind, it's normally a default. And then the banks, now they've got to move the whole file into another area, and it goes into the default file, non-accrual loans, and it's problems. It's just real problems for banks. So they want to shed those things. And people like myself are there to pick them up.
And why? So the bank wants to shed the note because why? Because there's a very specific reason why the bank wants to get that note off the ledger.
Yeah, because the bank is able to loan money on their deposits. They can loan 6 to 8%, or 6 to 8 times on any one deposit. So somebody deposits $100,000 and they can loan $800,000 on that $100,000. If they loan $100,000 and that note goes bad, then they've got to back that up with $600,000 or $800,000 worth of their own cash. And so it's really, it doesn't take very many of those loans before it really starts to tie the bank up, because their job is to loan money and make good loans. And so they're trying to get that off their books. They're trying to make sure that their balance sheets don't have too many bad loans on them, so that they can, they have to have some kind of a percentage that they have, and they got to stay within that little window for the feds.
Now, are those federal banking laws, like federal rule requirements?
Yeah.
Okay, so it's important to understand the reason a bank wants to get, and Gene just said this, but I'm going to repeat it because I think this is so key. The reason a bank wants to get rid of these is because federal guidelines and federal banking rules require them, if the note is non-performing, they have to keep 6 to 10 times the amount of that note in their reserves. So like Gene said, if it's $100,000 that's owed on that note, that can be $600,000 to $1 million that the bank has to have in cash on hand. So they need to get that off their ledger as soon as possible.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com.
Kyle, I want to go to you next and talk about this from the other side, the distressed homeowner side, because both you and Gene are dealing in residential, single-family, non-performing notes. How is this an opportunity for you to work with a homeowner when you acquire one of these notes?
So what we're trying to do is we're trying to solve problems, right? So when you look at this industry, you're solving 3 problems. One, you're solving the bank's problem, which they just talked about. The bank has a loan that, for whatever reason, has gone bad, and it's called velocity capital. You want to keep your money rolling. So they'll sell this stuff for a lot less because they're not local. They don't know local markets. They want to be landlords. They don't know what the inside of the property looks. That's the key thing here is we have no idea what the inside of these houses look like. You buy an REO, you're going through it, you're having your inspectors look at these things. This is not the case when you buy non-performing notes. That's why you have to get much more of a discount on it. So we solve the bank's problem by getting hold of their, getting their bad paper off there. We're solving the borrower's problem because the borrower has to live somewhere, right? So you can't just go to Holiday Inn and say, I want to live free. You got to stay free tonight. You got to live somewhere, or you got to stay somewhere. So you have to stay to play. So what happens here is we look at properties that the borrower or in the area is like, let's say, an 800 or 1,000 rent area. Now the borrower might be paying $600 or $650 a month. Well, now they're not making payments. Well, so there's a lot of reasons why that could be. Divorce is a big one. Sometimes I have a situation right now where it's a mother-daughter situation. Now they can't even be in the same room without just going fist to cuff. So we were able to solve that problem too by helping them. Is this working too?
Yeah, you're good. I'm just checking.
Okay. So we solved that problem too because they need to get out of the property. We just solved that problem as well. So now the borrower is sitting here and they have to live somewhere, right? So now they can't afford the payment, that $600, $800 payment. Well, I've got that note for that mortgage I bought for a lot less. So I can negotiate with them and get a better deal. So I'll go to them and go, hey, let's try to work something out here. I don't want their house. I don't know what the house looks like inside. I don't know what kind of repairs have to be made. It's a lot easier for me to get that discount and work out a payment plan with them. Sometimes it's just a matter of talking to somebody because a lot of people are afraid to talk to banks or they get the runaround. They're not talking to decision makers either. So once I bought this note, I can do a short sale if they need to in one day. They're talking to the decision maker. If they need to do a loan modification, I can approve that in a day. So we can make things happen a lot quicker, and we have a lot of exit strategies. That's the whole key as an investor, especially in the note investing space, is exit strategies. So look at it this way. You buy a note, you buy a house, an REO. I bought a lot of Grand Rapids stuff, frozen properties. I ran out there to get it back in the day. I didn't know what I was getting into. I had two choices. You can fix, flip, or rent. So fix and flip or rent. Now with buying a mortgage note, I have all sorts of other options. So now I can work out a deal with the borrower. The borrower does not want to work out a deal. Okay, well then I'm going to have to foreclose. I can sell that mortgage possibly to another investor for more than I paid for if I got a good enough deal. If I bought a pool of notes, I can sell that off. That's option number one. I can take the property back, sell it as at the auction, so people will buy the stuff at the auction. I'll have my spread, so I actually want that to happen at the auction. So if anybody buys stuff at the sheriff auction, that's ideal for our situation. We want that to happen. If that doesn't,
why do we want that to happen? So if you buy a note, a non-performing note, and it goes to sheriff's sale and sells, why is that good for you?
Because I paid 50, 40 cents of what they owe on it. So let's say it's $100,000 that they owe, I would be paying $40,000 probably for that unperforming mortgage. So I would actually set the price lower to move it. I've done that in Ohio and other states. We'll discount that to like 70 or where I think that they might just play on it. If that sells there, it's on them.
So you get your money.
I'm off the hook. I got my money. So that's plan number one, which would be great. It doesn't happen as often as you think. Plan number two is, or plan number one obviously is try to work something out with the borrower. Plan number two is to sell it off at the sheriff's sale. Plan number three is you're going to get it back after the sheriff's sale. If there's redemption periods, you have to deal with that too. So now you have a property that now you can get inside. All right, what do I want to do? Do I want to fix this thing up and flip it? Take my money and just be done? Short-term capital gains, all that jazz. Do I want to rent it out? I can rent it out. Maybe that's $800 or $1,000. Or do I want to just rinse and repeat with another borrower? So I fixed it up now. I'll give you an example. And let me know if I could talk about this forever.
I want to get to examples, but I want to
keep on going with
get some other input here. We'll kind of go back to Sue and then come back down. Sue, since we are getting into examples, you're more active in the commercial note space. What's an example of that you've been through where you've purchased a commercial note and how you've worked that out and made a profit off of it?
Well, one other motivating thing for the bank that was semi-touched on but not necessarily pushed through is that the bank isn't always in a position where they can play favorites and really work out a situation with this borrower. They certainly can't do it easily. And then the other thing is there actually could potentially be some legal ramifications if they make some sort of nice deal with one borrower and then don't make nice deals with others. So that's a big problem. That's a big problem. And once that bank comes up with that sort of like, okay, well, we could do this, we will do this, and then they give you that runaround. That's half the reason, because no one is actually there and capable. You get someone on the line, a nice loss mitigator who kind of takes liking to you and wants to help you, but they really are not in a position to be able to help.
If you are thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition 5 years ago, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB & Associates. Chad is a professional healthcare insurance agent who helps real estate investors and and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
For instance, when Kyle takes over these smaller notes, he's in an immediate position to help. So he doesn't have to worry about, well, what did I do with this person? What did I do with that person? He doesn't have federal and legal issues. So I am on a very different side of this, even though I'm very interested in single family, and I have done single family pools. I've done a lot of seconds and all of that. But I've done that as more of an investor, and I've had principals like Kyle who do the workouts and all that. So what I do, when you're doing a commercial note buy, you're doing one-offs. So that's really exciting to me because I can spend a lot more time and make a lot more money, and I'm working with a very principal of the bank. Because going back to what we've just discussed, when a bank loan goes bad and it's a non-performing note, the bank has to set aside about 7 times that actual note balance. So if I'm looking at a property that's $3 million, the note is $3 million, and the bank has it in their possession of non-performing, then they're going to have to set aside $21 million for that note. So I'm a great opportunity for that bank, but I'm also representing something where I can go in and I can help that bank and negotiate with the owner, with the bank's permission, by the way. You can never negotiate with the owner. Once the bank gives you a property, you cannot contact that owner without their permission. But I have found in the commercial field, because I'm working with maybe the vice president of the bank or vice president of special assets. Once it becomes special, it's typically in the non-performing note pile or REO pile. So this is my biggest strategy as a commercial investor. I use the opportunity to talk to the bank and say I buy both notes and REOs and sort of everything in between, because what I'm really doing is I'm offering the opportunity to buy that note, work out that note with the bank. The bank actually ignores me when I'm working with the owner, and then I'm going to do a deed in lieu. That's a deed in lieu of foreclosure with the owner, while the bank still owns the note, and then I will take it over the second it forecloses as an REO. And actually, typically, the bank will actually then take back the new mortgage on that new REO. And what have I done for the bank? I've basically relieved them of having to make a deal with the owner, having that owner go and talk to their other owners and tell them, oh, I got a deal. You see, so there's a lot of opportunity there. So I've used on several occasions with larger properties. I bought one property where the note was $12 million, and I bought the note that became the REO while I was owning it for $4.5 million. So that's a big opportunity there. Why would the bank want to sell that to me? Because they're having to set aside. It's a huge headache. The property managers are charging them an enormous amount of money to operate this property, because once they know that it's bank owned, they charge an enormous amount more. We did one deal which was really awesome. Another one using the exact same strategy. And this is how we kind of came upon this strategy, because the president of the bank, it was a small bank, it was actually in Ohio, and the president of the bank actually proposed that he would set up a side LLC and he would sell us the property, and we would negotiate with the owner. He would put it inside the LLC. He would fund the LLC at 100% of the of what we bought that note for, and what we ended up buying the property for. Now, remember, it's been a note. We've now brought it with the bank in tow as an REO. So it's a great strategy. It's a better strategy for larger properties because now I'm working with decision makers that can actually make a decision. With some of these smaller properties, you can get tied up in, the smaller pencil pusher people who are working there and the loss mitigators. But think about all of those opportunities and don't say you can't do it because the banks are motivated to do it.
That's why I like Sue's training, because she's got a lot of creative strategies. I mean, what you just talked about there is a really creative way of solving a bank's problem and acquiring a property at, for pennies on the dollar. Gene, I want to go to you next. You've got plenty of good examples of some wins and a few losses along the way, one of which we both incurred together. But can you just give us your experience with a particular note, like how it worked out for you, how you acquired it, how much you paid, and how it worked out?
You get what's called a tape from some of the different hedge funds, and there'll be 500 assets all over the nation. And that is all over the nation. And you boil it down to, well, you're going to do a couple of states. I'm kind of lazy, so I draw a circle, and anything within 150-mile radius is where I buy. And he just found out. And
I thought you just threw a dart at a dartboard.
A dart, yeah, it works too. And so you pick these notes out, and you buy these either in small pools. You buy them one-offs, which is one at a time, or we bought a mini pool not too long ago, which is 3 notes. We try to do a good drive-by, so you see with your own eyes what's going on. You have somebody you trust to see the property. I had one in my own town, and I see this on this tape, and I'm looking at it, and I'm thinking, $29,000, what? There's nothing less than 85 grand in that neighborhood. So whoever did the BPO for these people screwed it up. And
That's
so
a broker price opinion.
They kind of goofed it up. Well, I jumped in my vehicle and I drove over there. I drove around this house, and I thought it needs a paint job, big deal. So I went back and offered them $14,000 for it, and they took it. Now I've got this note, but it had $7,000 worth of taxes on it. I called up the homeowner. Again, you're in control. I have the paperwork. I own the mortgage of that note. I'm in control. I am the bank. Because of my business model, I have a lot of flexibility. And so I've still got laws that I have to, stay within, but I have a lot of flexibility. Called up the homeowner. I said, do you want to move out? What do you want to do? Do you want to give me a deed in lieu? Do you want to stay in your home? And he goes, wait a minute, what? I said, well, would you like to stay in your home? He goes, nobody's asked me that before. And this guy was almost in tears on the other end of the phone. He said, my wife and I got a divorce. It's just been real hard. I'm back on my feet. I've got my mind back. And because he really got stressed out, and it just got behind, and then it kept on snowballing on him. He said, what can we do? And I told him what we needed to do, but he needed to get his own taxes paid and stuff. And so we worked it all out. He went dark, by the way, which is, he didn't talk to me for 3 months. He didn't believe me. And so you deal with this kind of thing. You're somebody that's riding in on a white horse, and them going, no, there's no white horses, and there's no knights, there's no, this guy. And so he finally called me back up, and he goes, now, what did you tell me again? And I told him, and I said, I have to have a down payment. He said, I don't have any down payment. Well, you're going to have to come up with something for a down payment, and then you're going to have to get your taxes paid, and blah, blah, blah. And he goes, okay. Hung the phone up, went dark for another couple of months. Well, by this time, I've started foreclosure. And I don't normally play around. I'm pretty stringent on a lot of stuff. Because if they're going to go dark forever and ever, they're just playing me. Then they lose. If they're not playing me, then there's a way to, pull it all back in. He paid up his taxes. He gave me a couple $1,000s down, and then he paid an extra $200 a month. Well, what they had done, I bought this out of a Chase Bank pool, and they had really, really taken his arrearages way up there, just all kinds of fees and penalties, and it was crazy. And I said, I'll tell you what, whatever you give me extra, I'll take that money and double that and take that off of your arrearages. He goes, man, that's a great idea. So this guy's flipping me another $200 a month and bringing his debt down. The whole thing took 30 months. With my costs and stuff, I think my costs went up to like 17. And after I'd gotten payments and things, my entire investment was about $11,000. He had gotten remarried. He said, we're going to move. I fixed my house up. We're going to move and pay you off. And thanks. And they paid me off at $64,000 was what the balance of the mortgage was. So that was pretty sweet. I've had ones where I bought them for $6,000 and sold it 5 weeks later for $30,000.
Kyle, I know you've got an example too you wanted to share with us.
Sure, I can give a good example and give a rougher example I've been dealing with too. So here's how it can get you delayed as well. So I bought a non-performing mortgage in Florida, in Lauderdale Lakes, Florida, and they owed $225,000. The bank gave it to me for $102,000. And the realtors all day long were telling me I could sell this thing for $200,000. So they hadn't made payments. They hadn't made much contact with the borrower. So I tried to make contact. They made no contact with us. We're getting ready to finish the foreclosure. The day of the sheriff's sale, we get a notice that says they are petitioning to do a bankruptcy. That stops everything. No phone calls, nothing. Everything stops. The whole train comes to a stop. So then I had to get my bankruptcy attorney down there involved, and the issues with they wanted to do Chapter 13. The problem is they don't have any money. So for about 6 months, we went back and forth. We get the date set up, and they come up with a reason to come up. They needed more time for this and that. It's just, and especially in Florida, there's a lot of the bankruptcy lawyers down there just feed off this stuff. They love this stuff because they could just keep on racking up fees. So luckily, I got a good attorney on my end, and so it comes to the final date, and we're sitting there in front of the judge. I didn't go down there. I actually have never seen the house myself. There's a lot of properties I've never seen the inside. I've never drove by personally. I have that all done by professional services. That's one real advantage of this business is you can. Now that after the whole great recession, there's all these service companies that can really help you along. So by having those people in place, you have a team. And you don't have to reinvent the wheel. You have a service company that understands how non-performing work and how a performing note work and how the laws have to work. So you don't have to get yourself stuck in some sort of consumer protection agency problem. So anyway, back to my case. So the day of this deal, the guy goes in front of the judge and I was totally lying. I don't have any money because they were supposed to do this 13. So they threw out the case, and we're getting the house back. It's going back on the sheriff's sale next month. Now they could still try to do a 7 on us, but I don't think that's going to happen. So it's still a win because there's still equity in the house. It's just that's some of the things that can happen. You can get delayed on stuff. Now here's a bad situation that could happen. Let's say I'm trying to foreclose and I'm missing proper paperwork. And now you're sitting in front of a judge, just like we're doing right here. It's kind of a nervous situation. Anybody's been to eviction courts? It's always kind of a nervous situation in front of a judge. And I was in Lima, Ohio, and they said, "Well, where is the payments? We want to know every single payment this person's made." I thought my lawyer sat next to me had already sent it to him. I don't have it. He goes, "We're throwing this out," meaning that I'm done. I have to start the whole thing over, or I might even lose this property. So I'm sitting there looking at him like, what am I paying you for? But long story short is he gave us a continuance. I got it from our service company. They mailed it to me. I was able to print it out, and I gave it to him by the end of the day. So I had to stay in Lima. I was the first guy out there at 8:30. I was the last guy out the door at about 5:30 that day, but we got through the case. So that's stuff that can happen that you if you're going to get involved with this type of stuff, You definitely want to team up with experts that have done this before, the first couple ones. You want to deal probably with performing mortgages if you're, depending on, what you're really looking for. If you're looking for a project, go for non-performing. But by the time you get it, you might well, I could have just bought the REO, or I could have just bought the neighbor's house, because by the time you get in there, you've got all his repairs, you had all the court costs, you have delays, all this other stuff come about. So it's not always the easiest thing.
Buying notes is not.
Yeah.
It's not for beginners. You want to have
So
someone by your
that's
side.
a rough story. He gave a good example, so I was like, well.
Well, I like that you brought up the pitfalls, but I do want to make sure we get audience questions in.
This is great. I love these talking about notes. I've called banks or anybody that I've worked with before, and I've said, who do I need to work with, and I've gotten the response of, we don't actually do that here, I don't think. And so there's gatekeepers, or what am I doing wrong? How do you get in the door? How do you talk to the right people?
Can I just make a comment on that? In a bank situation, especially in non-performing and special assets and workouts, it's very typical that someone will be sitting in this cubicle and another person will be sitting in this cubicle, and this one's doing the bank workouts, and that person is saying that it's never happened at the bank. So they don't talk to each other at all, and actually, and there's a reason for that, because it's actually very confidential. Banks don't want to have that there's a possibility that they would work out your loan, period. And they also don't want to affect the market where usually banks have footprints where they have loaned to the same areas and all that. They don't want to affect their own market by doing this. So it is extremely common that there's only 4 people in the whole bank that knows that a workout's ever even happening.
So who do you want to ask for at the bank then? If you're making a call to the bank, who do you ask for?
So for me, go to the website and see who's working in special assets, who's working with special asset, the non-performing portfolio. I'll call directly. I'll try to get to sort of the top of that rung, some of the rungs, call directly to, and you'll get their secretary, and just announce yourself, this is what we're doing. We buy all over the country. We buy both non-performing notes and REOs. I was directed to blah, blah, blah. Now, I say I was directed to blah, blah, blah. I just saw his name on the website. That directed me. Use some language that makes it sound like you've brought, some other. I've had guys who've said, "Oh, I called the bank and they told me I needed to talk to this broker." Oh, that's awesome! You have the VIP of the bank who just told you to call the broker and go to that broker and say, "Hi, I'm Sue, and blah, blah, blah from the bank has told me that I need to get all the information on all of your non-performing notes." Do you see, you're putting yourself in a place of authority versus, do you know who I should talk to at this bank? Because I really went to a seminar and I found out that I could maybe buy non-performing notes, and I really want to do this business because my mother is sick and my father.
Right.
You just, think about approaching things from a multi-millionaire type of mindset. If I have a broker, this is another thing that I think comes up with banks, and some people get really nervous. They say, "Oh, he asked me for my proof of funds before I even get any information." That's such bullshit. It's out of control. These people, half of the brokers that are working for these guys are couch surfers anyway. Would you go on a date and say, "Unless you go home with me right this second, I'm never going to go out with you again"? It's not. I have never shown my proof of funds to anyone, actually. anyone. And the reason why is because that's personal private information of my private investors. How would and what are they going to do? They're going to go around me to my private investors. So you got to think in terms of a ballsy owner instead of I'm just starting this business now, and so when you're contacting these banks, these brokers or whatever, put yourself in a situation where, hey, you're working with us, we have, I have 2,000 units, go in with that attitude, and because I'll buy your deal.
And if you go in and a lot of times you try to avoid using the word or the letter REO, because if you say REO, she ships you off to the REO department right away. And so you got to kind of avoid REO coming out of your mouth.
Lastly, too, don't send them email by your Gmail account. It'll show that you're not a player. You got to have websites. You got to have a real company email. You got to look at they have a lot of liability on their end of it. They can't just start working with anybody.
Be vettable.
Yeah, vettable.
Okay, got another question here.
A typical bank has a certain amount of non-performing loans. Some of them do make it to the market as an REO. I guess my question is, why didn't they get picked up as a non-performing note from, say, one of you? What's the percentage, or is there a reason why some come to the market as REOs and don't get picked up?
I think it depends on the bank, really. Like a small community banks, they're not going to have as much paper, so they might sell off a one-off, but it's going to be very rare. We don't actually just call off banks right now. It's kind of, there's a lot of people calling right now, the banks, and you're just not making much headway because the market has gone up so much. So if you're sitting on a property, or if a hedge fund has bought these assets, and the unpaid balance is still accruing, going up, and the market values are still going up, why they want to talk to you? Why they want to give you a discount? They don't. They're going to let it sit, or they're going to wait till somebody pay 90 cents, which is crazy.
But yet notes are available. I mean, so because you're starting a fund, Gene and I are buying notes. So
Yep.
how are you guys getting those notes then?
Right. So what I found is that it's networking more than anything. So I go to the conventions. There's a Note Expo every year in Dallas, Texas. It's one in November. You're going to meet a lot of players in that, pass cards around. I just came back from, it's called an IMN meeting in Fort Lauderdale. The wife thought I was sitting there on the beach, but I'm sitting there doing stuff like this, I don't think I even saw the ocean once. But you start talking to these special these are the key people at these special asset meetings go to these things. So you're talking to these sources, and you get their cards. They see that you're real. Hey, I've got this, and here I am. I'm a real person. I'm talking to real people. I've got money, or I can come across some money. That's the way you're going to talk to these people and network through that. There's also brokers that will sell this stuff off. But you got to be careful because a lot of the stuff has been traded 2-3 different times, and you're not the first person seeing it. So if it's still sitting there, you got to go, well, why is it still sitting here?
Sometimes you find the gold. There's some of these people that are brokers for these larger companies, but you'll have to pay anywhere between $2 and $5 million to get into that club.
Buy $2 to $5 million worth of
Buy
notes
$2
to
to
get
$5
into that
million at a
club.
time. I have a really great connection right now, but I've got to put up $1.5 million to be able to buy from, I don't know if Bayview is really hard to break into. Chase is really hard to break into. Try $100 million before they'll talk to you. And so, you can't just go buy a one-off from Chase Bank unless, for some odd reason you have a really, really good connection. But to make these connections and find these hedge funds and find these asset managers and these brokers that are honest brokers, not people that ask you to make proof of funds. If somebody's asking you for proof of funds, they're probably not a good broker. They're taking stuff that they've gotten from somebody else, like a 500 tape that I would get, and I'm trying to call all my connections and broker out those tapes. And I don't know where the paperwork's at. I don't know how long it's going to take me, but I'm going to get money from them. I'm going to jack it up, and then I'm going to buy this note.
Like a wholesale situation, wholesalers, it's
Yeah.
that type of situation.
It doesn't really work well in this business.
Got another question here.
When you were giving examples, Gene and Sue, Gene, you talked about paying arrearages to Chase after you had bought the note. And Sue, you talked about you bought a note and then it went into an REO. It seemed like for less money than you paid for the note. How did those two examples work
Chase
out?
Bank had the mortgage that I was talking about. Chase Bank had that mortgage. And as they continued to not work with the borrower, they kept jacking the funds, the fines and late fees, and then they'd let it go and wouldn't talk to him for a while, and then he'd come back and they'd have attorney's fees, and it was a lot. It was I think, if I remember right, $8,800 worth of attorney's fees and fines and just crazy stuff on there. And I thought, I'm into this note, right? The property he sold the property for like $86,000, by the way. My payoff was $64,000. And so there was a lot of equity in there. And so that was what, when I bought that debt. I bought not only the unpaid principal balance, but all of the interest that was not paid, all of the attorney's fees that were added to the mortgage, all the late fees that were added to the mortgage, whatever, there's a certain amount that you can charge for a title search. So you do a title search on these properties. And you've got systems that you go down through and a checklist that you go down through that you need to be careful of. And you can buy a property and you can buy notes and stuff, but if people you're buying it from have all kinds of liens, because I buy private mortgages also, if they have all kinds of liens, it's going to pass on with that mortgage.
So in fact, you bought the note and the arrearages.
Correct. I buy the debt. I buy whatever the debt is at that particular price. And I base my price a lot of times on that.
Just think about it as all he's doing is he's taking the place of the actual bank. So he has all the rights of whatever that bank has charged for arrearages and all of that can then, it just goes straight into his hands. It's just, just think about just replacing that loan. You're now the new lender. The new bank.
Sue, the follow-up question to you was, you
I can
mentioned
answer
turning
that.
a-
So
basically took a
you
note and turned it into
misunderstood
an
what
RO.
I was saying. I didn't. So I have a different strategy than these guys in a lot of ways, because I'm working at a a one-off, much larger loan. So I don't have. It's interesting because the negotiation there. I worked with one bank. One servicer, and I was buying a 200 unit property, and it was about $4 million. And I was sending him emails, and the emails were about a paragraph. And the emails were just like, okay, I'd like to do this or whatever. The bank, the servicer came back and said, listen, no. I don't want a paragraph email. I just want to know what you want to buy it for, what you want us to lend on it, and what you want to, what the term's going to be, period. I mean, I want like 3 lines. So you're kind of cutting through a lot of the red tape the higher that you go. But the other thing, you had asked me, so my big push is to actually really work with the bank. I don't take possession of that note. I don't buy that note. typically. What I'm doing is I'm saying that I'll buy the note, but I'm proposing that what I do is bring it to the REO stage along with them, and then really purchase it once the deed in lieu is happening. I'll help facilitate the deed in lieu for the bank, and then I take possession of the actual property as an REO. So I'm using the opportunity of buying that note off of the property as really almost like a lure to then bring. And the banks really, I mean, not every bank. All banks are different. Someone asked over here how many notes. Why would one place sell a note? Why would one place want to sell it as an REO? Because it is completely random. It is the strategy of the bank itself, what they like to do, what the board at that bank likes to do.
Two questions, one sort of related. Do you guys, post 2014, the Dodd-Frank laws all changed? How does that affect how you guys do workouts? Does it? Do you buy notes after 2014? Do you have them sign affidavits that they did the origination properly, all that? And two, on the smaller deals, what is sort of your average? What do you figure when you're looking at a potential deal for legal costs?
Okay, so legal costs are going to be state by state, but let's just say probably be the safe side, $3,000 to $5,000 will get you through legal usually. Yes, Frankenstein is an issue. The Consumer Protection Agency after 2014, a lot of the notes that I target are prior to 2014 for two reasons. One is because of the laws, and two, because of equity. Those notes were bought at the right time. So the borrower has a lot of equity. We'll buy performing land contracts. So there's groups, in 2010, am I going a little tangent?
Go ahead.
Okay. So 2010, I think it was Warren Buffett said, hey, if I could buy all the houses right now, I would. Well, these hedge funds said, well, let's try to do that. So they went out and they bought Fannie and Freddie's paper, or actual REOs, at 5-10 cents on the dollar. They buy, we know one couple groups, whoever, right. Home Opportunity, those guys, they bought it 10,000 houses at a time, and they went big. Now, they have a problem. It's all throughout the whole United States, and they don't know what kind of condition these things are. So rather than do anything to the properties, they would just put a yellow sign up saying land contract, terms, blah, blah, blah. So we'll buy that paper, clean it up if we need to. We'll have legal look at it first, make sure that everything looks good there. But the idea is that stuff. So the hedge fund bought it for $5,000. Let's say the house was originally $100,000. Hedge fund buys it for $5,000, marks it up to $25,000 to the land contract holders at 10% mortgages. All day long, 9-10% mortgages. It's all out there. So we'll target that stuff for two reasons. One, there's a lot of equity that the borrower has, so they can refi and we get our spread because we're getting a discount. Usually we're buying that stuff at 70 cents of what's owed. So there's that opportunity there. And then the other opportunity is they can sell the property and we get that spread. They can refi, they can do nothing. And my borrowers are really protected now because we have a large performing note that's making money. It's got the equity the borrower has, and it has the equity I have. And then we have, if everything goes bad, we have a large equity where I could take the house back if I have to. I have a deal right now I just took back in Redford. And we're just going to do one of the options with it.
So
Dodd-Frank doesn't exist in commercial.
that's a good point. All right, this could go on for another hour, but it's time to end. So I want to thank our panelists. You guys have done a great job. Let's all give them a round of applause.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.